Hi everyone, in this video I'm going to be talking about my prediction on what house price capital growth percentage will be by the end of 2021. So right now in 2021, I'm going to use some data to predict what the capital growth prediction or percentage growth will be for the the calendar year 21. Okay, and like I can't predict the future, but I'm going to be sharing some amazing data points and some factors that you need to know so you can make a decision of whether you should be investing in this market or not.
Do you want to achieve wealth and passive income through property investing? PK Gupta, host of Oz Property Investment Mastery, will help you achieve passive income by buying top 5% growth and positive cash flow property and building a portfolio using data without you wasting months of time doing research, spending weekends at inspections, or dropping $10,000 to $20,000 on buyer's agents each time. So if you are confused and overwhelmed by the amount of contradictory information available online and don't know where to start, then this show is for you.
All right, so house prices. Are we in a boom? Are we in a bubble? Are we in a bust? What will they do? Are they about to tank? Will they continue going up? How much will they go up? If they bust, how much will they come down? These are all the things that you guys are thinking. I've already done 2 videos on this specific subject. Go back and watch them if you haven't already. I'll link them as well. And they will give you a lot of insight. But here in this video, we're going to be going very, very specific. All right, we're going to be going very, very specific. Hardly anyone really puts their reputation on the line to actually predict what the housing market will do. But that's exactly what I'm going to do. And it's not my opinion. My opinion matters nothing at all. I'm going to be sharing you a data-driven way of drawing an inference of what capital growth will actually do. Because you guys are listening to your friends, you guys are listening to your buddies, your colleagues, you know, none of them are probably financially independent, probably none of them have a decent passive income. And a lot of times, you know, you want to invest in property, you want to grow a portfolio, but you get all this noise. All right, you get all this noise from the media, from your friends, your devil's mind. She's sort of saying, oh, look, you know, this is the worst time to invest. You should wait till the market corrects itself. You should wait till property prices come crashing down, all this kind of stuff. So, you know, I'm obviously very self-interested in telling you that property prices won't crash, but that is indeed what will not happen. They will not crash. Now, let me prove it to you today. All right, so let's get into it. So, look, we all know that the housing market right now is driven, and I'm kind of referring to my notes as well. All my videos, I make notes so I can give you some pretty specific advice. The current market is driven by, you know, cheap money, by easy finance, by, you know, government intervention. There's lots of incentives out there and things like that. And I've already covered on the previous video how this boom is led by owner-occupiers. It's led by people like first home buyers, like upgraders, as opposed to investors. Investors are now slowly coming into the market, but the lion's share, more than 80% of all buying has been done by owner-occupiers. So, you know, when all of this is happening, house prices have been rising. So they've already risen by like 10% on average in the last 12 months. You know, when everyone was, you know, kind of putting a blanket over their heads, thinking that COVID is going to be the end of the world. Basically, in May last year is when prices started to go up a lot. So the question that I get asked a lot by all of you on YouTube, by my community on Facebook, everyone, is that, will this price growth continue? And if so, like how much? Is it going to go up another 10%, another 20%? What's going to happen? So what I've done, and I've drawn inspiration from a few different data sources, but I've kind of boiled the essence of this video into 2 data factors. The first data factor is price growth, housing price growth. All right, so everyone knows that. The second data factor is housing finance. Okay, housing finance. No one really buys a house in this day and age without getting a loan. So housing finance, or the ability or the appetite for people to get finance, or the policies or the appetite for lenders to provide finance, you know, as and when regulated by government bodies or APRA, etc. It's this lending game that really shifts the dial, that really helps us predict what house prices will do. It's incredibly important. Like, people think it's about population, people think it's about infrastructure, people think it's about migration, people think it's about unemployment. If population was booming, if immigration was booming, if infrastructure was booming, if employment was booming, but housing finance was soft. In other words, it's hard for people to get a loan because of bank policies, because of the Australian Prudential Regulator Authority policies, because of government intervention. Then even if those four positive things were going through the roof, house prices won't rise. And that's exactly what happened in 2017 when Sydney, Melbourne especially saw a correction of about 10%. Those house prices would have continued to go up, but it's housing finance that shrunk up. Okay, it's housing finance that shrunk up. I just thought of this analogy and it's kind of weird, so stick with me. It's like if you have a sponge, right? Like a kitchen sponge, right? So think of housing finance as water. If you've got a like 2-day-old kitchen sponge on your kitchen and there's no water in it, it's like all dried up. That is what, is the relationship between housing finance to house prices. Housing finance is water. You put the sponge on water and it balloons up, it blows up, it, expands. House prices expand. And even if you have the best sponge, even if you have the best kitchen, you've got your European appliances, if you don't have water, the sponge is not going to expand. Sponge is house prices, water is housing finance, all right? So I'm always doing these weird analogies. Sorry about that, guys. So I'm going to look at a chart right here in front of me right now that I've developed. So what this chart correlates is housing finance all the way from 2002 to house price rises. So what we saw I'll go through some key periods just to help you understand that there is actually a correlation. So in 2008, right in the middle of the GFC, it was called a credit crunch. In other words, housing finance or the ability to get a loan became harder. The water was taken out of the economy. So between 2007 and 2008, housing finance dropped 10%. Property prices, or the growth in property prices, dropped 30%. All right, so annual change in housing finance and house prices. House prices in 2008, they dropped about 20 to 30%. Not everywhere, in some key locations. So, housing finance dried up 10%, and property prices came down a big way. Now, what happened after the GFC, after the credit crunch, was in 2009, 2010, housing finance blew up. So housing finance grew by 40%. What house prices did, what the sponge did, was grew by 20%. All right, are you with me so far? So we start to see that there's a correlation between these two things. And then after the GFC, if you were around at that time, for those of us who have been through a couple of cycles, everything came out of the GFC rosy. But then there was like this period from about 2011 to about 2012 or 13 where Europe and some other, European economies and the US, they kind of came out of the GFC, but they were still very weak. Like, Greek went into default, Italy, et cetera, et cetera. It was a pretty terrible time. So then housing finance came down again. It came down by 20% in 2011, 12. House prices then started easing off as well. So instead of growing by 20% the previous year, house prices, they didn't fall, but they grew not at all, basically. And then you had this period from 2012 to 2000 and about 14, 15, where housing finance grew by 20%. And that is where house prices grew by 10% and 20% consistently year after year after year. That was the housing boom, the previous housing boom, right? And then what happened is that in 2017, housing finance dropped by 10%. Now that is the Australian Prudential Regulator came in and said that, hey, banks, there are way too many investors buying properties. We need to shut the gate. This is becoming out of hand. We're not going to allow you to give more than 30% of your loans to investors. And even then, you can only increase your loan book to investors, even within 30%, only by 10% per annum. 10% per annum. So housing finance shrunk. That the water evaporated out of the sponge, and then the sponge dried up. So between 2016 and 2019, you saw housing finance really come down 10 to 20%, and house prices also corrected. I'm looking here at my chart by around 10 or 15% on average. Okay. Now, this is the key thing. Now we get juicy. So in 2020, housing finance went up. We talked about low interest rates, loose monetary policy. We talked about fiscal policy. We talked about all the government incentives, the new bills, stamp duty concessions, first homeowner grants, blah, 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 JobKeeper, job seeker. Housing finance grew in 2020. So this was last year, the calendar year, by 10%. And house prices last year grew, they grew by between 5 and 10%. In some places more than 10%, but let's just say 5 and 10%. What's happening right now is if you forecast, well, don't even forecast, you look at right now, the current housing finance percentage, it is growing by more than 10%. Right, more than 10%, not versus 2017, not versus 2016, versus 2020. Which is already a growth year. Housing finance I'm talking about. So the ability to get loans, like pre-approvals, all this kind of stuff, right? Because obviously you need a pre-approval, or you need to know that you have borrowing capacity before you start looking for houses. So it's like a leading indicator. And what's happening now is if you track the momentum, and what I've done is I've looked at some multivariate regressions. There's only about 4 or 5 different factors, so I've not really had to normalize it for autocorrelation. But if you look at the regression and you pull the current trend of housing finance forward, what you see is that by the end of 2021, this year, housing finance will have risen almost 25 to 30%. 25 to 30%. That is more, like this, I'm not trying to create FOMO here, but that is more than it has ever risen in the last 30 years since I plotted this chart. All right, so housing finance is now rising way, 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 way more than the last 30 years. And I've just demonstrated to you over the last 13 and a half minutes that in fact, there is a statistically reliable correlation between housing finance and capital growth or house prices. We're talking national. Of course, there's always areas that outperform, underperform, markets within markets. Don't just take this advice and go, put a blindfold on and buy a property. You need to be very focused. But there is a clear correlation, all right? And I'm a statistician. I studied econometrics. This stuff is real. It's not just not making this up. If you pull forward housing finance, by the end of 2021, it is going to be going up year on year by almost 30%. What that means is that house prices are anticipated to go up by about 25%. By about 25%. Okay, and so you're like, okay, well, where'd you get that 25% number? If you regress housing finance versus capital growth or house prices, you get that coefficient where house prices go up a little bit more than the percentage growth of housing finance, or when housing finance drops, the percentage comes down, the house prices drop a little bit more. There's a correlation of a coefficient that we've been able to produce. So looking at that correlation, looking at that coefficient, if housing finance drops, then house prices drop a little bit more than that percentage, right? But right now, what we're seeing is by the end of this year, housing finance will go up by about 25 or 30%. And 20 to 25%. And what that means is that house prices will also have risen in this calendar year by about 25%. Now, they've already risen this year, so I'm not saying they'll rise more, another 25% from right now. But from January, by the end of the year, I would not be surprised if house prices went up to a total of about 25%. Now, that's a pretty phenomenal statement to make. Like, it could even be 30%, right? But once again, like, if you look at a chart and you try to understand what the correlation is, generally speaking, housing finance is a really, really, really good indicator of house prices, agnostic to what anything else is doing. Because even if you're saying to me, PK, well, how are people going to afford this? Housing finance is the biggest indicator of affordability. If they can't get borrowing capacity, which is housing finance, if they can't get the pre-approval, then they're not going to buy houses. People will only buy if they can afford. It doesn't matter if incomes are increasing in the short term, only matters on how much you can borrow, right? Connect with this point. Like, this is a really important point, because a lot of people say, oh, there's no wage growth, it's hard to save up, in Sydney prices are astronomical, people can't afford it, people can't afford it, people can't afford it. But how can people buy houses they can't afford? The thing is, they can afford them. And that's because they're getting the requisite or prerequisite loan. And that loan is being dished out to them because they can afford it. Australia has one of the tightest lending policies in the world. Like, we're not in the US where you can issue a low doc loan to a PAYG employee and someone just makes up, their income. You can't do that in Australia, right? You can't do that for PAYG. You can kind of be a bit dodge and do that for ABNs and GST registered businesses, but not for PAG. And most people are employees, they're PAYG. So the fact is that people can afford it, and housing finance proves that, right? This is just data just shared with you. This is just data. It's not my opinion. So when you correlate housing finance to capital growth, then you start to see these things. And then you're asking me the question, all right, PK, well, you're saying that house prices will have increased by 20 or 30% by the end of the year. Great. Well, then, you're shooting yourself in the foot, because then they will come crashing down. Here's the thing. All right. So what's going to happen? Let me tell you right now, is that there's only ever been 3 instances where a price boom has been led by owner occupiers or upgraders, right? Like in the last boom in 2013 to 2017, that was led by investors, right? So property booms don't finish the same way. Some finish with a huge correction and some finish with a shallow correction. The ones that finish with a huge correction, those are the booms that are led by investors, speculation. The ones that end with only a small correction, those are the ones that are led by owner-occupiers. These are the people who are actually living or upgrading. They're not speculating. It's not an investment. This is the last thing they'll sell if times become tough. So the current boom has been caused by homeowners rather than investors. And what this means is that we can expect prices to stabilize rather than crash. And I've done a whole video on this, but here are 3 specific examples or 3 data points or 3 case studies to prove this point once again. Because I know a lot of you, you might be doomsdayers, or you may not be, but you know that people are, they're influencing you, they're stopping you from basically making money in the property market. And that's not a good thing, right? Like, we're not trying to get a Ferrari or anything. We're just trying to get ahead for our family. So I just want you to have the confidence. And here's the 3 case studies. So the best way to actually forecast what might happen in the future, next year, the following year, whether there's going to be a huge crash or just a stabilization, is actually just to look at what's happened in the last 3 booms, not chronologically, but in the last 3 booms that were driven by home buyers, not investors, but home buyers. And let's see what actually happened, right? Like, let me not just make this stuff up. Let's actually look at the data. So believe it or not, the last 3 booms that were driven by home buyers as opposed to investors in Australia occurred at the end of World War I, at the end of World War II, and just before the GFC. All right, so let's go through the first one. And I'm not making this up. This is literally the only 3 times have booms in Australia been led by home buyers. This is the current one is 1, but there's only been 3 before in this century or the previous century. So in the World War I, when it ended, and I think it went from 1914 to 1918. It ended in 1918, 1919. So a lot of soldiers kind of returned, to start their families, back in Australia, back from Europe and things like that. There was a lot of migrants that were fleeing Europe, a lot of refugees that came back from Europe, especially because it was just, diabolical over there. It was just ravaged famine and poverty and things like that. So what that meant was that was a population-driven boom for housing in Australia. And there were severe shortages, right? Supply and demand. And so what happened was that house prices grew by over 50% in just 3 years. In 1919 and 1920, 1921, house prices grew by 50% in 3 years. What happened after that? After that 50% increase, they corrected by about 8 or 10%. All right? And then they started going up again. So that was case study number one, a housing boom led by home buyers. The second one was World War II. And surprise, surprise, it was a very similar situation. So once again, Second World War ended, started in 1939, ended in 1945. After 1945, similar reasons, refugees, immigrants, the world was really bad place. Australia was, relatively speaking, unharmed, strong economy, safe, everything like that, everything that we have these days as well. So soldiers returned, migrants, refugees. It was the same sort of story. In fact, this was the biggest boom that Australia has ever seen. House prices tripled in 5 years. So like in World War One, they grew by 50% in 3 years. In World War Two, they tripled. House prices tripled. Connect with that. They tripled in 5 years. All right. So once again, it was led by home buyers. And after that happened, house prices corrected from about 1951 to 1953. They corrected by about 10%. And then they started going up again sustainably based on macroeconomic drivers and microeconomic drivers. And then the third case study, the third home buyer boom took place just after the federal government's introduction of the first home owner grant in year 2000. I think that was the first time that a first home owner grant was established by the federal government, making it easier for new home buyers to buy property, to live. And that boom basically continued until 2009 in the GFC, which I went through before. And in this boom, house prices doubled in about 7 years, or in about 5 to 7 years, 6 to 7 years, you could say. So from year 2000 to about year 2006, 2007, they doubled. And what happened in the GFC, even in the GFC, prices only contracted by about 10 to 20%. And then, as I explained before, housing finance, they started growing again. So if you look at these three case studies, the biggest contraction was about 10 to 15% after the GFC. And that was because a GFC occurred, right? It wasn't just because there was a bubble, that actually something came extraneously to burst house prices. But if you put that to the side, let's say the GFC didn't happen, then even though there was a price boom from year 2000 to year 2006, there was still only a price correction of 10 to 20%. So let's say the GFC didn't happen, it would may have only corrected 10% or less than 10%, much like the World War I and World War II booms. There wasn't a crash. So, I just really want to, this is a long video, but I want you to really understand what happens, right? At the end of each of these booms that were led by home buyers, prices corrected by about 5 or 10%. The GFC meant that it was a little bit more. So right now, we're right at the start of a boom. A boom, if you analyze all booms going back in time, they last about 3 years or a little bit more than 3 years, and really the climax or the key, driving momentum part of the boom. This boom started in the middle of last year. We're about a year in. It's not going to end tomorrow, like I've demonstrated by telling you the correlation between housing finance and forward housing finance and house prices. It's not going to end next year either, because a housing boom doesn't really ever last just 1 year. That's never really happened. It will last at least 2 to 3 years. And then what will happen is that it won't be a crash of housing prices. Even if something amazing were to happen, like a GFC or coronavirus, version 2, looking at the GFC example, housing prices would only come down about 10 to 15%. But in that time, they would have already risen by well over 50%. Right? So, I really want you to understand, are you happy to live with a 10% correction if they've already risen by 50, 60, 70%? Right? They've already risen 10% last year. This year, I've just told you that they'll probably rise between 20 and 30%. So that's 40% overall, just using rough math. And then let's say this boom continues for another year, which statistically it is incredibly likely to do, because that's the normal duration of the boom. So what's that? 10 plus, let's say 20 or 30, so that's about 40%. Next year, another 10 or 20%. So we've cracked the 50 mark easily. And then after that, if they crash or they correct by 10%, we can live like that. It's not going to be a crash. So look, there's a lot of me rambling, but here's the point. you are at the start of the cycle. You're at the start of the boom, relatively speaking. This year is going to be an incredible year for price growth. It will crack that 20% mark according to that regression analysis that I've shared with you. And even though all housing booms always correct, it's not like a linear sign, they always correct in a shallow way if they are led by home buyers, not investors. And right now they are. It's very unique. This is only the fourth boom that has this quality in Australian history over the last decade, over the last century. So I want you to take home, this data. I want you to allow your mind to marinate in it. I want you to focus not on what your colleagues are saying, your friends or family, or what other experts are saying. I want you to trust economics. I want you to trust data, and I want you to trust logic. No one really shares this kind of thing openly because A, hardly anyone is qualified to share it, and B, it takes time to do the work. But if you can, scratch 4 or 5 layers deeper than the average person into the data, then that's really the way to build confidence and make some serious money. So, guys, hopefully that's been useful. My name's PK, and I hope you guys make a lot of money, whether you're buying to live or buying to invest in this year, next year, and the following year in the Australian property market. Catch you later.